all of us earn income, part of which or whole of which is spent. If whole of which is spent, there is no savings. If more than you earn, you spend, there is borrowings. Or if after your income you spend part of it, the result is savings. Now, savings have different avenues to invest. Savings have to be invested judiciously, where you get a fair rate of return. Now, the options that present to an individual is either to invest in a fixed income bearing securities or capital appreciating securities. When it comes to fixed income securities, basically it is fixed deposits. Now, do fixed deposits give you a rate of return adequate enough to take care of inflation? The answer is no. It is only psychologically that you are happy that you have invested in fixed deposits. But if you take into consideration inflation and taxation, there is a negative rate of return. So basically, you do not get a fair rate of return when you invest in fixed deposits. Except for the fact that the capital is safe from depreciation, but not safe from inflation. If you take into consideration inflation, then your capital is eroding. So what if you could purchase X number of units presently with a capital? Years later, you will find that you are purchasing less number of units with the same capital. So therefore, over a period of time, the capital depreciates. And therefore, the return that you get in real terms is a negative rate of return. These are, as far as fixed, it could be debt, it could be any type of fixed bearing instruments where your rate of return is negative over a longer period of time. Then you have capital appreciating assets. As far as capital appreciating assets are concerned, you have bullion, that is gold, silver, property, or equities. As far as gold and silver are concerned, now, silver is not a very attractive investment. There are very few who really invest in silver. Most people invest in gold. But gold, as an asset class, if you consider over the last several years, has not given any return. There are sporadic periods of time when there is a crisis or when oil prices go up, when gold prices go up, but then they stabilize for a period of time. Now, gold, as an asset class, also, there's no income accrues to you. There's no dividend or interest on gold. Secondly, also, okay, now you can hold gold in a demat format, but then many people or many individuals are not aware of that. So gold is held in its physical form, where it always runs the risk of theft. So you have to place it in a fixed deposit locker, which has a cost. So gold as such, taking into the cost and not generating any income, also as an asset class, is over a period of time has not given a return which is good enough. And then you have property. As far as property is concerned, yes, property as an investment comparatively is safe. But again, the returns depend from area to area. Now, the property is, unlike stock, shares, which I'll come to it later, is that a stock can multiply. Let us say somebody held shares of Infosys in 1995, 10,000 shares. Today is over 1,02,000 shares, or more shares. So your 10,000 shares have multiplied, whereas Eicher Motors or Maruti or shares multiply. But your property does not multiply. If you are staying in a society with 12 apartments, 20 years back and 20 years today also, the apartments don't multiply, it will be the same. If you've got a flat 10 years back, 20 years back you have purchased it, it will still remain one flat. Except the prices would go up, maybe due to inflation and the development around the property. Now development will depend on place to place. There are certain places where the development does not take place, certain places where development takes place rapidly, so appreciation is what you get. But at the same time, the ticket size is large. You property, specifically places like, okay, you are from I'm told that Dubai property prices have crashed, but in places like Mumbai also they are steady, but the ticket size is large, running into crores. Now it's not affordable for everybody. Secondly, yes, you get rental income, but at the same time, selling is a difficult proposition. It's not very easy to sell because then there is stamp duty, there's registration charges, there's brokerage. The cost is very high in terms of transaction cost, and also there's a delay. There will be a huge delay in terms of time where you get a buyer. And then, if again it is all or none. In the case of, which will come back later, stock, if you have 100 shares of Tata Steel, you could sell and you require, or you have 1,000 shares of Tata Steel and you require urgent money, you could always sell part of it, or 1,000, 200, 300, and maybe when you get the money, buy back. But when it comes to property, and if you have a 500 square feet apartment, you can't sell one bedroom and keep the balance. You have to sell all or none. So that is a limitation as you have. So property as such may give you some type of return, but it is not within the capacity of everybody to invest. Then the next option is equities, that is shares. As far as equities are concerned, among all asset classes, it has been proved time and again over a period of time that as an asset class, equities have given maximum return over a period of time, and again with the rider, provided the decisions are right. What is the advantage of equity is that the ticket size is very small. Technically, let us say technically, the trading lot on the stock market is one share. Let us say you take this technically, you take the price of Jayaprakash Associates. The price of Jayaprakash Associates is 1 rupee 50 paisa. Lot size is 1. So therefore, your minimum entry could be as low as 1 rupee 50 paisa in terms of the entry. The entry levels are very low. Secondly, stocks also give you dividends, which okay, property gives you rental, gold does not give you anything. It gives you dividend. Again, buying and selling liquidity is very easy. As I said, if you are holding 1,000 shares and you require funds, you could sell 50, 100, and possibly you also have the option of buying back once the funds are back to you. So, and tax friendly. Short-term capital gains 15%, long-term capital gains 10%. So today, if you are earning salary income, you are paying if you have a salary income, you will be paying as what we call taxes 35%. But on stock market, even short-term gains 50%. So the rate of taxation is investor friendly. So equities as investment class option gives you the maximum return if the decision you take is right. As said earlier, that an investment in Eicher Motors in 1984, just an investment of 10,000, today is valued at 900 crores without taking into consideration dividends. Similarly, an investment of 10,000 in the year 1980 in Wipro is valued at 600 crores today. There are many such illustrations and instances to prove that equities give even a passive investment, doing nothing, you just do nothing. You merely invested in 1980, the BSE Sensex was valued at 100. So in 1980, if you bought the Sensex and did nothing, today it is 40,000. The number of times 40,000. So as passive investment, that does not require any type of analysis or any type of research. All you do is invest into a passive investment like the index. And if we are all convinced, as said by Edwin, that if we are to migrate to an economy of 5 trillion and 10 trillion by 2030, then growth is automatic. There may be short-term aberrations, but over a longer period, it is the economy that will drive sectors and companies. In fact, I think what Natasha had said a couple of days back, that there is fear all around, that whomever you meet, talks about recession, talks about slowdown. Yes, as far as, see, there is no stock market, if you look over the last century, there is a perpendicular rise. Every stock rises are punctuated by declines. And declines are part of any economy. There is no economy which will just move. So therefore, there are periods of slowdown. There are government takes decisions. So having established the fact that equities are the best form of investment and they outclass all other assets over a longer period with a rider that provided the decision is right. Now, over the last few months, we have been witnessing a decline in the Indian stock markets. There are a lot of companies which have declined to such an extent that they are virtually putting at their lows, and further decline does not seem possible considering the prices at which we are. This is because there is, okay, slow down the economy. Every economy witnesses a slowdown, and slowdown also results in stock prices declining. And that is the time where investors who have conviction in the stock or in the economy purchase, because at that time you get these shares at a price, and every economy at some point of time turns around with a lag effect, and then the returns are phenomenal. See, every market operates on hope, fear, and greed. These are emotions. So when emotions take the stage, it is time that you take advantage of the emotions. The emotion of fear is greater than the emotion of greed. Now, by experience, everywhere, in all spheres of activity, this is my personal experience, which I can over years share, that any opinion that you seek, you go, if you have a heart problem, you go to a cardiologist. The cardiologist will give you an opinion. Still, despite the fact, if he is an expert cardiologist or a deputy cardiologist, you will still not trust his opinion. You may go for second opinion or third opinion. In every sphere of activity, whether you go to a dentist, you go to any, you take second or third opinion, and you will not trust the opinion in any stages, even of an expert. But I observe when it comes